The air crackles with a familiar unease whenever the word recession is spoken. Headlines scream of impending doom, and the collective psyche often defaults to a primal fear of scarcity. But what if this prevailing narrative, so often fueled by speculation and emotion, is obscuring a more profound truth? What if recessions, far from being unpredictable calamities, are actually cyclical phenomena governed by underlying economic forces that, when understood through the lens of data, offer not just survival, but a pathway to securing our wealth? Benjamin Graham, a titan of rational investing, taught us the profound wisdom of the margin of safety. It's the bedrock principle of building a buffer, a financial fortress, against the inevitable storms. This isn't about blind optimism or wishful thinking. It's about constructing resilience through deliberate, empirical tactics. We're not here to predict the precise moment the winds will shift, but to equip ourselves with the tools to withstand any gale. In this exploration, we will move beyond the generalized anxieties that cloud so many discussions about economic downturns. We will dissect the very essence of recession resilience, focusing on 6 distinct, data-driven tactics. These aren't mere suggestions. They are actionable strategies designed to transform the perceived chaos of market contractions into a landscape where your wealth is not just protected, but actively secured. Prepare to challenge the conventional wisdom, to embrace a more analytical, a more robust approach to safeguarding your financial future. Is your current financial strategy truly built to endure, or is it merely hoping for fair weather? Let's begin to build that fortress. Recessions, as we've begun to understand, are rarely isolated incidents. They are more akin to a complex, interconnected system where a subtle pressure drop in one area can trigger a cascade of effects throughout the entire network. The prevailing narrative often simplifies these events into a stark market crash, but the reality is far more nuanced, a subtle invisible handshake of economic forces that can destabilize even the most seemingly robust portfolios. To truly secure our wealth, we must look beyond the headlines and delve into the underlying data. Consider the historical relationship between broad market drawdowns, like those seen in the S&P 500, and contractions in gross domestic product. While often correlated, the timing and magnitude can diverge significantly, revealing systemic risks that a superficial analysis might miss. These are the hidden currents that can pull even seemingly stable assets into the turbulent waters of a downturn. Many hold the comforting belief that diversification is an infallible shield. However, data from past crises tells a different story. During periods of extreme stress, correlations between traditionally uncorrelated assets can converge, meaning that balanced portfolios can experience synchronized declines. It's like finding out all your lifeboats are made of the same vulnerable material when the ship begins to founder. This is why understanding these interconnected economic forces, using statistical correlations and leading indicators like yield curve inversions or manufacturing purchasing managers indexes as our pressure gauges, is not just insightful, it's essential for anticipating and mitigating systemic shocks. Our first data-driven tactic, therefore, is to implement a correlation matrix stress test. This involves regularly analyzing how your specific assets have moved in relation to each other during past downturns. By identifying where your portfolio might be over-concentrated in correlated risks, you can strategically rebalance towards assets that demonstrate genuine uncorrelated or counter-cyclical behavior. This isn't about predicting the future. It's about understanding the underlying atmospheric pressure of the economy and building a financial shield that can withstand the storm. The onset of a recession often awakens a primal fear within us, a deeply ingrained instinct that can lead to some of the most damaging financial decisions we make. This isn't a failing, it's a deeply human response. Neuroscientific studies reveal how fear can hijack our rational decision-making, pushing us towards actions that, in hindsight, are often counterproductive. We see it in the data, the panic selling that locks in losses, the desperate scramble for perceived safe havens that are, in reality, overvalued and poised for their own corrections. Consider the analogy of a pilot navigating severe turbulence. The instinct might be to react erratically, to yank the controls. Yet, seasoned pilots, armed with data and rigorous training, understand that a steady hand, a disciplined adherence to procedure, is what truly ensures safe passage. Similarly, historical investor behavior data, such as the dramatic swings in fund flows during crises, starkly illustrates how emotional responses, driven by this fear, lead to the classic pitfall of buying high during exuberance and selling low during panic. A common myth suggests that the safest course during a recession is to simply exit the market altogether. However, the data paints a compellingly different picture. Missing even a handful of the most critical trading days following a downturn can significantly erode long-term returns. The cost of this fear-driven hibernation can be far greater than the perceived risk of staying invested. Therefore, our second actionable tactic is to establish predefined re-entry triggers. Instead of allowing emotional emotional impulses to dictate our actions, we create objective, data-based criteria for re-entering or increasing positions. This might involve setting conditions, such as when the price-to-earnings ratios for high-quality companies fall below a specific historical average, or when the volatility index stabilizes below a certain threshold for a defined period. Fear is undeniably a potent force, but data provides its rational, powerful antidote. By understanding our own psychological vulnerabilities and equipping ourselves with these data-driven triggers, we can navigate recessions not as passive victims of circumstance, but as strategic survivors. As economic uncertainty looms, a common instinct is to seek refuge in assets traditionally labeled as safe havens, think bonds or gold. Yet, the narrative of absolute safety often overlooks a crucial reality. These havens come with their own set of hidden costs and limitations. To genuinely secure our wealth during a recession, we must look beyond the comforting labels and scrutinize the data. Imagine choosing a shortcut through a dense forest during a storm. It might appear to be the most direct route to safety, but hidden pitfalls, unexpectedly high transaction costs, the erosive power of inflation, or even sudden, sharp drawdowns in the perceived safe asset itself can render it more perilous than a well-understood, albeit longer, path. We must analyze real-world data. What have been the inflation-adjusted returns of these supposed safe havens during past recessionary periods? How liquid are they truly when markets are in distress? The widely held belief that bonds are an infallible hedge against equity declines often crumbles under data scrutiny. Historical analysis reveals periods, particularly during inflationary recessions or when interest rates are on the rise, where bond markets have experienced significant drawdowns that have coincided with, or even exacerbated, equity declines. The comforting predictability we associate with bonds can evaporate when the economic climate shifts dramatically. This leads us to our third actionable tactic: conducting a real return and liquidity audit on your existing safe haven assets. This means calculating their inflation-adjusted returns not just over one cycle, but over the last 2 or 3 significant recessionary periods. Simultaneously, assess their immediate sellability without incurring substantial price concessions. This rigorous data examination might reveal opportunities to consider alternatives, such as high-quality dividend-paying stocks that offer income and potential growth, or specific alternative investments known for their lower correlation to traditional markets. Securing wealth is not merely about avoiding losses. It's about understanding the true cost of your perceived safety, allowing for more informed and resilient financial choices. Recessions, in their relentless nature, serve as a rigorous test of the underlying strength of business models. While many companies falter under the pressure, those possessing robust economic moats, durable competitive advantages that shield them from competitors, demonstrate remarkable resilience. Analyzing data on these companies reveals a consistent pattern of superior performance and swifter recovery when compared to weaker entities during downturns. Imagine a formidable medieval castle complete with a deep, wide moat and high, imposing walls, preparing for a siege. This castle is built to withstand assault. Contrast this with a flimsy, poorly constructed building. When the economic storm hits, the castle endures, perhaps sustaining minor damage, while the flimsy structure is likely to crumble. Our moat indicators are the financial metrics that signify such strength: consistently stable profit margins, conservative debt levels, and unwavering free cash flow generation. These are the data points that reveal a company's inherent defense against economic adversity. A persistent myth suggests that all companies are equally vulnerable during a recession. However, empirical data consistently debunks this notion. Companies fortified with strong economic moats not only weather the storm more effectively, but often emerge from the downturn in a stronger competitive position. This allows the powerful engine of compounding to reassert itself more rapidly, creating significant long-term value. Our fourth actionable tactic is to implement a moat strength scorecard. This involves developing a system, both quantitative and qualitative, to rigorously assess companies. We evaluate factors such as the strength of brand loyalty, the presence of powerful network effects, advantageous regulatory environments, and significant cost advantages. By systematically scoring companies on these critical elements, we can then strategically target investments in those with the highest moat strength, positioning our capital for sustained compounding even amidst economic turbulence. In the face of economic storms, true wealth security is found not in chasing ephemeral trends, but in the enduring strength of fundamentally sound assets. In periods of heightened economic uncertainty, the strategic deployment and redeployment of capital transform from a mere portfolio management task into a critical act of defense. Simply maintaining a static allocation, often lauded as a set-it-and-forget-it approach, can prove insufficient when the economic landscape shifts dramatically. We must embrace data-driven methodologies to actively fortify our portfolios, moving beyond the illusion of passive security. Consider a seasoned general role on a dynamic battlefield. Static defensive positions, once established, can become vulnerable to flanking maneuvers or overwhelming assaults. True strategic advantage comes from redeploying forces based on real-time intelligence. Similarly, data analysis provides the crucial intelligence needed to shift capital towards areas offering the greatest protection or the most compelling opportunities for preservation and growth. We will utilize valuation metrics, market sentiment indicators, and forward-looking economic surprise indices as our essential battlefield intelligence, guiding these critical capital movements. The myth that a passive, unchanging investment strategy is always optimal, particularly during recessions, is actively contradicted by data. Empirical evidence suggests that proactive, data-informed adjustments can significantly enhance risk-adjusted returns and, crucially, improve capital preservation. Our fifth actionable tactic is to develop a recessionary capital rotation model. This involves establishing a framework that utilizes quantitative signals such as moving averages, relative strength analysis, or economic surprise indices to identify sectors or asset classes demonstrating relative strength or presenting undervalued opportunities during downturns. By systematically adjusting our allocations based on these objective signals, we transform our portfolio from a passive spectator into an active participant in its own defense. Securing wealth in a recession is an active endeavor. By treating capital allocation as a dynamic, data-informed defense strategy, we transform our portfolio from a vulnerable target into a resilient, adaptive fortress. We stand at the culmination of our journey, having moved deliberately beyond the often unsettling narratives of fear and speculation that typically dominate discussions around economic downturns. We have instead embraced the clarity and power of data, exploring 6 distinct, actionable tactics designed not merely to help your wealth survive a recession, but to actively secure it. Recall our exploration. We began by dissecting the interconnected, systemic risks that often lie hidden beneath simplistic market crash scenarios, learning to use data as our guide. We then confronted the insidious influence of behavioral biases, understanding how fear can amplify losses and how predefined, data-driven triggers can serve as our rational antidote. We scrutinized the traditional safe havens, revealing through data the hidden costs and limitations that often accompany their perceived security, prompting a more rigorous audit of their true value. Furthermore, we identified the enduring strength found in companies with robust economic moats, emphasizing how data analysis can pinpoint these resilient entities poised for recovery and compounding. Finally, we shifted our focus to the dynamic art of capital allocation, understanding how data-informed, active rotation can fortify our portfolios against evolving threats. These 6 tactics, understanding systemic shocks, managing behavioral pitfalls with data, scrutinizing safe havens, investing in economic moats, and practicing active capital allocation, collectively form the blueprint for your financial fortress. They are the embodiment of Warren Buffett's timeless wisdom. Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. Our data-driven approach is the ultimate expression of this principle, transforming the inherent uncertainty of economic cycles into a strategic advantage. The power to secure your wealth through market downturns lies within your grasp. By consistently implementing these data-driven tactics, by remaining vigilant and informed by objective analysis, and by cultivating a critical, questioning mindset, you are not just preparing for a recession. You are building a foundation for enduring financial resilience. Your journey to truly secure wealth, fortified by data and reason, begins now.